Dave used to think the stock market was just a scary place with red and green numbers moving around for no reason. It looked like a game for rich people. Charts went up, charts went down. People shouted about companies Dave had never heard of, and Dave thought, this is not for me. But then he learned what a stock actually is, and once he understood it, money started making a lot more sense. Today, Dave is going to explain stocks in the simplest way possible. No fancy Wall Street language, no confusing jargon. Just one clear idea that can change how you think about investing. A stock is a small piece of ownership in a company. That's it. If Dave buys a stock, he does not just own a number on a screen. He owns a tiny slice of that business. He becomes part owner. Think of it like pizza. Imagine a giant pizza that represents a company. The company wants to grow bigger. Maybe it wants to open more stores, make new products, or hire more people. To get more money, it can sell pieces of itself. So Dave buys one slice, not the whole pizza, just one slice. That slice is a stock. If the company grows and does well, Dave's slice can become more valuable too, so when the business wins, Dave can win too. That is the basic idea behind stocks. Now, there are two main types Dave needs to know about. The first one is common stock. This is the type most people mean when they say stock. Common stock usually gives Dave a vote in company decisions. It also gives him the chance to benefit if the company grows a lot. So if the business becomes huge, Dave can do really well. But there is a trade-off. If the company struggles, the stock price can fall too, so common stock is like a roller coaster. More growth potential, more risk too. Then there is preferred stock. Preferred stock is a little different. Dave usually does not get the same voting power, but he may get more predictable payments. It is a more steady kind of stock. If common stock is a roller coaster, preferred stock is more like a train, still moving, still useful, just a little calmer. So the simple difference is this. Common stock gives more growth potential. Preferred stock often gives more stability and income. Then Dave learned about one of his favorite ideas, dividend stocks. Some companies make a lot of money, and instead of keeping every dollar, they share some of their profits with the people who own their stock. That payment is called a dividend. Dave loved this idea. It meant he could own part of a company and sometimes get paid just for holding the stock. It felt like owning a little piece of a business that sends him cash once in a while. But Dave also learned something important. Dividends are not guaranteed. A company can change them, reduce them, or stop them if business gets hard. So dividend stocks can be nice, but Dave still needs to understand the company behind them. That is the real lesson. Stocks are not magic. They are ownership. A stock is a piece of a real business. Common stock gives more growth potential. Preferred stock gives more stability. Dividend stocks can pay cash to shareholders, but not forever and not always. Once Dave understood that, stocks stopped feeling random. They started feeling like a tool, not a shortcut, not a gamble. A tool for building wealth over time. If this helped, subscribe, and comment what Dave should explain next. Stay with Dave. The Money Map is not finished yet.